and obviously there's way more than one thing that each of us would say, hey, Federal Reserve, it would be great. So why don't I start with Julia? Tell us about like the top of your list for them.
So I think first I'll say that they've done a really good job of being aggressive early, and that was sort of the lesson learned from 2008. And I think they've done so well getting ahead and short-circuiting an economic crisis from becoming a financial crisis. So I think that that's, I want to start by saying that. And then I think what I see as a deeper, longer problem is that we're in a world where interest rates are going to be really low for a very long time, as far as we can see. And so the traditional tool of interest rates just isn't going to be as effective. And so what is their next tool? Their next tool is the balance sheet. But they, you know, there are limitations to that. And so one proposal that, and the limitations being that, again, they can be lender of last resort, they can short circuit financial market tightening, they can't give money out to the economy. And if there's an economy that doesn't want to borrow through the credit channel and respond to low rates, then your impact on the economy is going to be really attenuated, really limited. So if your goal, if your mandate is to get to full employment and get inflation to your target, you're going to need better tools in this world that we live in. So what do those tools look like? So this is my pie in the sky. You asked for it.
Go for it.
You're going to get it. My pie in the sky, I have a proposal with Simon Potter for, one, the Fed to create a digital currency, a system of digital payment providers for consumers, which is basically formalizing something that's already developing, but bringing it in-house, bringing it under the regulatory net, making it backed by reserves at the Fed. And then you know, all of this would have to be authorized by Congress, who is the Fed's boss at the end of the day, at the beginning and end of the day. But that they could be authorized to then use those digital accounts to provide stimulus in a downturn. So we could use a trigger like the Sahm rule, or like hitting the zero lower bound on rates, and then you trigger deposits into people's accounts. That is direct money creation.
So not a loan, you just send them money.
Not a loan, it's just money, and you're printing it. And instead of relying on that credit channel to work, low interest rates stimulate borrowing, and that gets money out into the economy, you're just getting money out into the economy. And it would have, it would be ring fenced. There would be limits to what they could do. It would be defined in advance, so it's not fiscal policy. It is a monetary function. They're not solving all problems. In fact, I think if they had that tool this time around, they would be asked to do less of what they're being asked to do right now, if that makes sense. Like now they're being asked to lend to state and local governments and medium-sized businesses and you know, high yield corporations. That's kind of crazy. Instead, they could just give money directly to consumers, and that in and of itself would reduce the risk that markets are worried about anyway, right? If consumers have a backstop, then that tail risk that causes markets to seize up wouldn't be as big.
So can the Fed do this?
They would have to be authorized. So we have
Congress has got to tell them it's okay.
Yeah, so we have a proposal for a framework to do so. Those ring fences around it, that if Congress authorizes it, that they cannot do it now. They are not allowed to do it now. And otherwise they would, right? But we see this as a more efficient way to maintain that role that the Fed is playing now. I think what we're seeing is the Fed is being asked to do all kinds of things that it just simply can't do very well. And it sort of puts their independence at risk. And I think if you give them a better tool, a well-defined but more effective tool, then it can keep doing the job it does well.
That makes sense. All right, Nellie, it's your turn. Blue skies.
Okay, so I'm going to stick with a Fed that uses interest rates and asset purchases and forward guidance as its main tools. And in terms of blue sky for the next year, okay, I think they have a big obligation to try to get more loans out to Main Street businesses. And it is not something that I think is a long-term objective for the Fed. It is a response to this crisis. And it's an unusual crisis that it hit businesses and they lost money, and Congress has given them money from Treasury to help do this. And if once, you know, maybe this isn't a great thing to have to do, but if you're going to do it, then you should do it right. And they should go and be willing to accept some losses on Treasury capital for this. I think one of the wrong lessons learned from 2008 is that Congress can allocate some funds like TARP, and it will all get paid back and more. And somehow that seems to be a view that whatever they gave to businesses in the CARES Act of $454 billion, somehow the Treasury is supposed to return that plus more, or at least that's how they've internalized their use of this. And this is a solely different kind of situation where businesses lost money, and somehow you have to socialize those costs, that lost revenue across government and businesses. So I think the Fed really needs to improve this program in ways to get it to more borrowers. And they use banks, so the Fed's not going to pick who gets the loans. They're using the banks to determine who gets the loans. But it means you need to give conditions to borrowers. They're willing to borrow at whatever prices, and banks can participate, like they're not taking on more risk than they can assume. And then you still have to protect the Fed. So it's a complicated program, but it's doable. And other countries are doing guarantees on small business loans, or they do funding for lending, which I don't think is as effective, but the guarantees are good. The Fed hasn't gone that, the Fed and Treasury haven't gone that way yet, but I kind of think that maybe over the next few months, they might have to. But it's important, those small, medium-sized businesses, even those, you know, more than, you know, 100, you know, even those beyond the like 10 employees or 100 employees, they are big employers. And we estimate they, you know, employ about 40% of the workforce. You need to get money to those businesses. So that's my pitch for where.
That's a very good one. And it, like you said, it's territory the Fed has not been in before. They supported as a lender of last resort in 2008 and afterwards, they went in to make sure that Wall Street, that like financial markets kept functioning. And the argument was always, and it's a valid one, that households and small businesses all benefit if you can still go to the bank and get a loan. And so, but they didn't take the step, and there are various reasons for this, but they didn't take the step of directly lending to Main Street, which this time.
But they're going to do this through banks, though. So it does
No,
require that the banks be sound enough to actually execute this.
Oh, right. So it's
they may not have had that option before.
No, that's a good point. I guess the one thing, so the facilities, so the lending facility to the medium-sized banks, the lending facility to municipalities, that was announced, if I remember correctly, on April 9th, right before Chair Powell gave a talk at Brookings with David Wessel. I was absolutely in tears by the end of the talk. I was just like, oh, I love the Fed, and Jay Powell sounds like he's like
he did a great job that morning. It was
that was beautiful. And then David Wessel had some like really over the top parting words. But that was April 9th. Those facilities have been announced. The Fed, and I do love like, they don't like tweet out, we're going to do one thing, and then 2 days later they walk it back because markets freak out about it. Like the Fed is very deliberate, and they want to make sure when they do it, it's going to work. Unfortunately, in the time that's passed, there are businesses that have gone from being what we call liquid, you know, they have a problem of like, they don't have enough revenue right now, they can't pay their employees, but it's a temporary thing, to businesses that really they're going under. And there's some businesses that already failed that like get absolutely nothing from the Fed. And you mentioned this before, and Julia said too when she talked about high yield, and essentially that's something between junk bond or like we give you loans to businesses that there's a really high probability you're never going to be able to pay us back.
Yeah.
Right. So that's the taking losses. And what's unfortunate is in the time that has passed, you've had a lot more businesses and municipalities move closer to that.
Yeah.
You're not paying it back. And then these losses, I mean, I agree, we're a victim of our own success with some of the prior bailouts because like, oh, we give out money and it comes back, you know, more than we even lent out. And that is very unlikely to be the case this time. And if you continue these programs, which I think we'll need to, the cost will start piling up and people notice. Like they notice when the deficit gets bigger. No one, I mean, there's a really small fraction of the people that look for the balance sheet releases of the Federal Reserve and get all excited about, oh, there's more money.
Wait, what?
So it's a different, thing. But no, I think that's good. And one thing that I've heard talked about that made me very angry with a whole series of macro academic men is the idea that the Fed is just out of ammo. Like, I think it's important to think about what Julie's saying, out of ammo, like that they're just not gonna be able to do anything. So Julia's point, and I do agree, in a low interest rate environment, and this is not going away, we need to think about other tools.
Right.
The Federal Reserve is like totally woke to this. They spent like the better part of last year doing listening sessions and FOMC meetings, which I imagine were something like paint drying, like some of the discussions, but like they were onto it.
Yeah.
And in June, this month was supposed to be when we learned about the outcomes of all these discussions. I have a feeling, well, I actually think what, and I don't know this, but I feel like sometime in March, they like moved past everything that had been a serious discussion in Fed Listens or in their framework review, but they were ready to keep acting. And I saw this in 2008 in the recovery, you know, they hit the zero lower bound, and really anything past that had been a very like theoretical exercise before it happened. And then it's like, well, we're not giving up. It's like, we'll do quantitative easing and we'll do forward guidance and we'll, you know, so to me, the Fed had proved last time, like, I don't think they did enough and I don't think they were bold enough, but like they got the principle of you just keep doing like what we're doing and like, what's the blue sky